January 29th and 30th, 2026. Mark those dates, because they represent the most violent 48 hours in the history of the precious metals market. While the world watched in absolute horror as silver collapsed from a record high of $121 per ounce down to a staggering $76, a nearly 33% decline in a single session, something far more calculated was happening behind the digital curtain of the COMEX. This wasn't a natural market correction or a simple case of profit-taking. This was a coordinated, strategic crash, a controlled demolition designed to trigger a cascade of liquidations and shake the silver out of your hands. If you think this was just market volatility, you are being played by a system that thrives on your panic. The crime scene began on January 29th, when silver hit an all-time high of 120.46, marking a 298% surge over 12 months. The gold-to-silver ratio had collapsed to a 14-year low of 45.1, and the momentum was becoming uncontrollable for the big banks. To stop the surge, the CME Group deployed what I call the margin hike weapon. On January 27th, they increased the margin requirement from 9% to 11%. This meant that for every $400,000 in silver a trader controlled, they suddenly needed significantly more cash on hand just to keep the position open. By the time the Reuters exclusive report dropped on January 30th, citing anonymous sources claiming the U.S. would end strategic metal support, the trap was set. Algorithmic trading systems and forced liquidations did the rest, wiping out billions in paper wealth in minutes. But here is the divergence you weren't supposed to see. As the paper price crashed $45, the physical reality was screaming the opposite. In that same 24-hour window, 3 million ounces of physical silver were scrubbed from the vaults. We are currently facing a massive 230 million ounce structural supply deficit. The COMEX registered silver deposits have dwindled to a precarious 105 million ounces. This is why the price action feels so fake, because it is. We are operating in a market with a 356-to-1 paper-to-physical ratio. For every 1 actual ounce of silver in a vault, there are 356 digital promises claiming to own it. The crash was a desperate attempt to lower the price so that industrial giants and sovereign wealth funds could satisfy their immediate needs before the physical vaults hit zero. The math behind the industrial floor is undeniable and cold. In 2025, solar production consumed 161 million ounces. Each electric vehicle requires significantly more silver than traditional cars, and 5G base stations require 3 times the silver of 4G infrastructure. You cannot build a green revolution or an AI-driven economy without this metal, and there is no substitute. China knows this, which is why they just implemented strict export restrictions requiring an 80-ton minimum production capacity and $30 million credit lines. They are cordoning off their silver for national security, while the West sells its paper silver for $76 an ounce. This brings us to the ultimate question: who is on the other side of your panic sell? It isn't other retail traders. It is the smart money, the sovereign wealth funds, the central banks, and the industrial conglomerates who are paying record premiums in Shanghai while you see a discount in New York. Even the Perth Mint is feeling the heat, with a 25.5% crash in AUD terms causing absolute panic in the Australian markets. This is the 2011 playbook repeated with higher stakes. Back then, they used margin hikes to kill the rally at $50. Today, they are using them to defend the system at $121. The success formula for this moment is simple, but requires nerves of steel. Avoid the leverage traps and own the physical metal. When the paper market eventually defaults, which the 3 million ounce one-day drain suggests is a looming reality, the gap up will be so violent that $200 silver will happen in a weekend. The banks have handed you a gift, a $76 entry point in a world where the physical supply is practically exhausted. If you want the specific data sheets, the margin hike documents, and the inventory tracking I've used today, click the link in the description to join our insider research group. If you are holding physical through this manufactured massacre, comment holding below and subscribe to stay ahead of the next raid. Don't let them scare you out of the greatest wealth transfer of our generation. The paper lie is perhaps the most sophisticated financial illusion ever constructed. While you may think you own silver because a digital ticker tells you so, the current market structure reveals an 11-to-1 leverage ratio that should terrify any rational investor. For every single ounce of physical silver sitting in a vault, there are 11 paper contracts claiming ownership of that same ounce. On January 29th, the big banks and bullion dealers exploited this fragility by flooding the market with sell orders for silver that does not even exist in physical form. This wasn't about price discovery, it was a liquidity raid. The COMEX inventory is currently at a critical breaking point, and by driving the price down artificially, these institutions are hunting for your stop losses to satisfy a massive industrial demand that they can no longer meet through honest supply. This leads us to the fundamental math that they simply cannot manipulate: the industrial floor. In 2025, solar energy production alone consumed a staggering 161 million ounces of silver. As we move further into 2026, that requirement is only accelerating. Consider the 5G infrastructure rollout. It requires 3 times more silver per base station than 4G. Add the unrelenting pivot toward electric vehicles, which utilize nearly double the silver of internal combustion engines, and you realize that silver isn't just a shiny metal for collectors. It is the high-tech oxygen of the modern world. There is no substitute. When a commodity becomes non-discretionary and the physical supply is shrinking, while the paper price is falling, you are looking at a spring-loaded market. The industrial floor for silver is currently estimated between $80 and $90 an ounce, yet the paper price was slammed down to $76. That $14 gap is where the biggest fortunes of this decade will be made. But who is actually on the other side of this trade? While retail investors in the West were panic selling their positions during the January crash, the world's sovereign wealth funds and central banks, particularly those within the BRICS nations, were the ones quietly emptying the vaults. This is a geopolitical chess move. By suppressing the price in London and New York, the Western financial system is inadvertently allowing its global rivals to accumulate physical metal at a suppressed discount. We are witnessing a historic migration of silver from west to east. Once that physical silver leaves the COMEX or the LBMA and enters a private vault in Shanghai or Riyadh, it is removed from the paper leasing system forever. This creates a physical squeeze that will eventually make the 2011 rally to $50 look like a minor fluctuation. The historical precedent is clear. When the divergence between the paper lie and the physical truth reaches this level of tension, the snapback is always violent. In the 2011 cycle, we saw silver nearly touch $50 before a series of margin hikes destroyed the momentum. Today, the scale is vastly larger. We are seeing premiums on physical coins and bars reach $10 to $15 over the spot price because the market knows the spot price is a fiction. Even the Perth Mint has seen unprecedented demand as local buyers realize that the paper price is disconnected from the reality of global shortages. The solution for the intelligent investor is simple. Stop playing the bank's game. If you hold paper ETFs or leveraged certificates, you are holding a promise that may not be honored when the system defaults. The success formula in this environment is to own the physical metal, sovereign coins and bars that have no counterparty risk. When the COMEX finally fails to deliver, a day that draws nearer with every 3 million ounce drain we witness, the price will gap up so rapidly that $200 silver will become the new baseline overnight. The banks have handed you a final gift, a $76 entry point in a $200 reality. Do not let their manufactured volatility scare you out of the greatest setup in the silver market we have seen in over a generation. If you want to see the specific data sheets, the 11-to-1 leverage charts, and the inventory tracking I used in this analysis, click the link in the description to join our insider research group. If you're holding physical silver through this crash, comment holding below so we can see who has the conviction to see this through. Subscribe now to stay ahead of the next market raid. I'll see you in the next one. The evidence of an industrial floor is no longer just a theory. It is a mathematical certainty that is currently colliding with a shrinking supply. In 2025, we saw solar photovoltaic manufacturers consume a staggering 161 million ounces of silver, a number that has effectively turned the silver market into a strategic energy play. As we move into 2026, global solar PV capacity is forecast to reach 665 gigawatts, which will lock in another 120 to 125 million ounces of non-discretionary demand. You have to understand that this isn't like jewelry or silverware, where buyers can simply wait for a better price. If you are a high-tech manufacturer like NVIDIA or Tesla, you cannot build your products without silver. Each electric vehicle requires between 25 and 50 grams of the metal, and with global EV production forecast at 14 to 15 million units this year, that adds another 70 to 75 million ounces to the tally. Then you have the 5G infrastructure rollout, requiring up to 10 times more base stations than 4G, and the massive expansion of AI data centers. Silver is the high-tech oxygen of the modern world, and with the industry now consuming over 50% of total annual supply, the floor is firmly set. We are currently facing a sixth consecutive year of structural deficit, with demand exceeding mine supply by roughly 160 to 200 million ounces. This leads us to the climax of this market war, the massive divergence between the paper market and the geopolitical reality. While the CME Group was busy raising silver maintenance margins to $32,500, a 47% increase in a single week, to protect trapped bullion banks, the BRICS nations and sovereign wealth funds were doing the exact opposite. On January 26, 2026, as gold exploded past $5,000 and silver broke through the $110 threshold, the smart money wasn't looking at the futures ticker in New York. They were looking at the vaults. We just witnessed an unprecedented 3 million ounce physical drain from COMEX-approved warehouses in a single 24-hour window, bringing inventories to their lowest levels since early 2025. Total stockpiles have plummeted by 117 million ounces, or 22%, since the peak in September. This is a geopolitical chess move. By allowing the paper price to be slammed by algorithmic sell-offs and spoofing tactics, the Western financial system is essentially subsidizing the physical accumulation of silver by its global rivals. Once that metal leaves for Shanghai or Moscow, it is gone. It will never return to the paper leasing system that maintains the 11-to-1 leverage ratio we see today. The historical parallels are undeniable. In 2011, they used margin hikes to kill the silver rally at $50. Today, they are using them as a desperate kill switch, while the metal targets $200. Even the Perth Mint is seeing massive premiums as retail demand far exceeds available supply. The big banks like JP Morgan and Goldman Sachs, who spent all of last year telling you silver would average $36, have missed the biggest rally of the century, and their revised targets are merely a way to cover their own short positions. The success formula for the 2026 silver storm is clear. Stop playing the bank's game on their home turf. Avoid the leveraged paper traps and focus on physical sovereign coins and bars. We are witnessing the great divorce, where the physical price is being set in the East, while the paper price in the West becomes a ghost town of unbacked IOUs. The banks have handed you a gift, a $76 entry point in a market where the industrial demand floor is rising and the physical supply is at a terminal breaking point. Don't let them scare you out of your position. If you want the specific data sheets, the 5G industrial loading stats, and the inventory tracking I've used in this analysis, click the link in the description to join our insider research group. If you are holding physical through this manufactured crash, comment holding below. Subscribe now to stay ahead of the next market raid. I'll see you in the next one. While the West watches the digital tickers on Wall Street, A much more profound shift is occurring in the halls of power across the BRICS nations. We are currently witnessing a geopolitical chess move that has turned silver into a strategic monetary weapon. While paper prices were slammed down to $76 in New York, physical silver in Shanghai was trading at a massive $20 premium, and in Japan, prices hit the equivalent of $130 per ounce. This isn't just a price difference, it is a confession of systemic failure. The smart money, led by the sovereign wealth funds of Russia, India, and Saudi Arabia, is no longer interested in the paper promises of the London and New York exchanges. They are executing a historic de-dollarization strategy by moving their reserves into hard, physical assets. Russia pioneered this by explicitly incorporating silver into its state reserves in 2025, and now the release of the 247-page operational blueprint for the BRICS unit has changed the game forever. Silver is officially designated as a Tier 2 reserve asset, intended to back 20% of this new trade settlement currency. This means BRICS central banks now require billions of ounces of silver that they simply cannot source at these manipulated paper prices. This sovereign shift is creating a great divorce between the artificial prices on Western screens and the reality of the physical vaults. Once that metal is withdrawn from the COMEX, like the unprecedented 3 million ounces we saw exit in a single day, it is gone. It enters private sovereign vaults in the East and will never return to the paper leasing system that supports the 11-to-1 leverage ratio used by bullion banks to suppress prices. The villain in this story is the paper manipulation machine, but their spoofing tactics are running into a brick wall of physical scarcity. By January 2026, silver lease rates exploded to 8%, a massive jump from the typical 0.3%, proving that the market is so tight that participants are willing to pay an 8% annual fee just to borrow the metal for delivery. We are seeing a structural market failure where the paper price is being used as a kill switch to protect trapped banks, while the physical market is undergoing a permanent upward repricing. The success formula for this historic moment is clear. Stop playing the bank's game on their home turf. If you hold paper ETFs or leveraged certificates, you are holding a promise that may be settled in cash just as the real moonshot begins. The path to wealth in the 2026 silver squeeze is through physical ownership. Focus on sovereign coins and bars, assets with no counterparty risk. The banks have handed you a final gift, a $76 entry point in a world where the industrial floor is $90 and the sovereign target is $200. When the paper market finally defaults, the gap up will be so violent that most investors will be left behind. Do not let the manufactured volatility of the paper lie scare you out of the physical truth. If you want the specific technical specs on the BRICS unit, the 11-to-1 leverage data, and the inventory tracking sheets I've used today, click the link in the description to join our insider research group. If you are holding physical through this crash, comment "holding" below to show the banks we see through the illusion. Subscribe now to stay ahead of the next market raid. I'll see you in the next one. So, what is the ultimate play in a market where the rules are being rewritten in real time? The success formula in this environment is not about out-trading the high-frequency algorithms or the bullion bank spoofing machines. It is about recognizing that the $76 paper price is a temporary accounting illusion designed to facilitate a massive physical transfer. The solution is simple. You must stop playing the game on their home turf. If you are holding leveraged paper contracts, digital certificates, or unallocated accounts, you are effectively providing the banks with the very ammunition they use to short the market against you. The path forward is the total prioritization of physical sovereign coins and bars, assets that have zero counterparty risk and cannot be canceled by a margin hike or a Sunday night exchange rule change. History shows us that whenever the divergence between the paper lie and the physical truth reaches a breaking point, like the 3 million ounce one-day drain we just witnessed, the snapback is violent. The banks have handed you a final strategic gift, a $76 entry point in a world where the industrial floor is rising above $90 and the geopolitical target is $200. While the Perth Mint sees 17% localized crashes and retail panics, the smart money is using this dip to lock in their final positions before the vaults hit Terminal Zero. This is your window to flip the script. Don't be the investor who sells at the bottom of a manufactured crash. Be the one who recognizes that the most essential high-tech commodity on Earth is being sold at a discount by the very people who desperately need to buy it back. The time for theory is over. The time for position building is now. If you want the specific data sheets, the 11-to-1 leverage breakdown, and the real-time inventory tracking I've used to expose this plan, click the link in the description to join our insider research group and get the full technical report. If you have the conviction to hold physical silver through this manipulated massacre, I want to hear from you. Comment "holding" below so we can show the algorithms that the retail market isn't folding. Make sure you subscribe and hit the notification bell to stay ahead of the next market raid. This is a war for the world's most undervalued asset, and I'll be here to walk you through every move. I'll see you in the next one.